You're welcome to the Forex Trading and Lifestyle Entrepreneurship channel. Do take a minute to pause this video and read this disclaimer.
Hi, it's Victor here from foreshowmarkets.com. In today's video, I will be sharing with you some of the most effective and prominent Japanese candlesticks patterns you will find while trading or while analyzing your charts. Okay, and so just like we did continuation and reversal patterns for chart patterns in candlesticks, we are also going to see continuation and reversal patterns in the market. Okay, so all of this technical analysis is simply to show us or give us an idea of what the market is. It's simply about using the past information, okay, historical information and the current information to forecast, analyze what is likely going to happen in the nearest future. Okay, so there are different candlesticks patterns you will see on your live chart. Okay, so this is a live chart and this is what your market looks like. Okay, so for me, I change my colors. My bullish candle is green while my bearish candle is red, and we are currently on the 4-hour time frame. So it simply means that every single candle here is showing us a 4-hour it's giving us information for 4 hours. Okay, now every single candlestick gives you information that you can use to trade profitably, and that is what you're about to learn. Okay, every single candlesticks individually, and also the set of candlestick formation, okay, helps you interpret price. But let's start with the single candlesticks formation. Okay, now this is why we say the candlesticks method of interpreting price action is much better than the line chart. Okay, and let's look at a few examples. This is what you call this pattern. So all of these patterns, you see them in the market. Okay, before I go ahead, let me let you know that candlesticks, you know, is what will I call it now? Is a niche on its own. It's a very, very wide niche and a wide concept on its own. Okay, for you to learn everything about candlesticks, it can take you, months and years. Okay, so candlesticks is very wide. There are 1,001 candlesticks patterns. All right, but what I usually tell my students is pick the most effective and the most prominent patterns, okay, and master those patterns and use for your trading. You really don't need to know every single candlestick pattern out there. Okay, all depends on what strategy you choose to major on. Okay, so I'm sharing with you the most prominent and most useful Japanese candlesticks pattern you will find in the market today. Okay, so we start with the Gravestone Doji. Okay, we start with the Gravestone Doji. This simply means that the market opened at a certain price. Okay, it's either I went down or went up. Okay, market opened at a certain price, went lower, then went higher, and printed a high here, printed a low here, and then after the price was bullish up here for a while, the sellers. So candlesticks is basically showing you the interaction and the fight between buyers and sellers. It's showing you the interaction or the struggle between the bulls and the bears. So it simply means that the bulls overpowered the bears and took the price up as high as this. But then when the price got this high, okay, some more stronger bears came into the market and started selling and sold so hard that they pushed the price back down to the initial starting point. Okay, to have in such a way that the price opened and it came back and closed at the same price. That is your Gravestone Doji. Okay, the doji, all of these are doji, and the doji is one of the, in fact, I think the doji, another word for it is the pin bar, okay, because it forms like a pin. Okay, this is one of the most useful and effective means of knowing when a market is about to change direction, okay, or also letting you see immediately on that particular candle what is going on, or that particular, 1, 2, 3, 4 candles around it. Who are those who are winning the struggle? Is it the bulls or the bears? Okay, so when you see this kind of price action on your chart, it's simply letting you know, giving you an idea that the bears are above here, okay, above that price there, that the bears are really strong there, and so buyers need to be very, very careful, anywhere up here. Okay, let's look at it on a chart. Okay, so I'm looking at EuroCAD, and let's look at the typical example. You can see this here. Can you see this here? Hold on. Okay, I hope my mouse is showing there. Okay, so you can see this here. Very, very sweet, giving you a lot of information. Now, let me just go into the reason why the Japanese candlesticks is more prominent than the line chart. So I'll look at this point here. This pin bar here, I'll change it to line chart. Can you see that these are just lines? Okay, and I really cannot see the price action. In fact, the line chart has hidden the price action that happened at this. Okay, and this is the reason why the candlesticks is so much better, because it gives you more information. It gives you, real-time feel, real-time feel of what is going on in the market as in right now. Okay, so I'll change it back to candlesticks, and you will see this. Can you see? This immediately shows me a lot of information that buyers, this is a support, okay, and there are buyers below here. Okay, so as a seller, the moment you see this kind of pin bar, it should give you a heads up, telling you, you know what, it seems the buyers are coming into the market and you need to take your profit and run. But when you change it to a line chart, you really can see that information there. And this, to me, is one of the most important reasons why most traders prefer to use the Japanese candlesticks, because every single candle shows you a lot of information that the ordinary line chart will not show you. Okay, so you can see now price was coming down, the bears were in control, and then all of a sudden we had a pin bar. Now remember that you are not the only one trading this market, and there are many traders worldwide. And the market is, your chart is a reflection of traders' emotion and traders' psychology. Okay, and this psychological effect is common to traders worldwide. Okay, and so once they see the pin bar, everyone is thinking it's time to buy, or for those who are selling, it's time to close my sell. Okay, and then you see is the effect, a head mentality, whereby once everyone sees this, they start being careful and closing their sales and switching to buy positions. You will see it all over your chart. Okay, all over your chart. Let's look at this. This is powerful. So, one of the things the candlestick chart shows you is that long wick. Once you see a long wick to the upside or to the downside, that is a very, very big heads up. Okay, let me check another chart. It's a very, very big heads up for price reversal. Okay, look at this here. Very, very powerful. Okay, very, very powerful. So once you see your pin bar, your doji like that, it's simply telling you that this market is about to change direction, either a retracement or a complete reversal like you have seen here. Okay, very, very powerful stuff. You shouldn't take this information for granted. All right, so let's look at more examples of the doji. Okay, so here you can see the opposite. This is a Gravestone Doji. You usually see it form when price is going up, and then once you see this form, it gives you an indication that price is about to retrace or reverse completely. Okay, the opposite of the Gravestone Doji is the Dragonfly Doji. Now take note, I don't really know the names of all, I never bother cramming the names of all these patterns. Okay, so you don't need to bother yourself about cramming the names. You don't need to know what the names are. All you need to know is that when you see something like this in the market, your mind starts telling you what to expect. Okay, so this is the reverse of the Gravestone Doji. It's called the Dragonfly Doji, and I've shown you an example already. It simply means that the price opened here, the sellers pushed the market down, right? But the buyers were stronger at this point, and defending that point, pushed the price back up and closed at the same price, right? So for this one here, the price came back down to close at the same price it opened. Same here, the price came back, pushed up and closed at the same price it opened. That is how you form your doji. Okay, the price usually opens and closes at the same price. And then here you have what you call a long-legged doji. Okay, so you can see that the wick to the upside and the wick to the downside is probably almost the same thing. Okay, so price opened and closed at the same price. So this basically shows you that there is a struggle between the buyers and the sellers. There's a struggle between the bulls and the bears, and no party is actually at that point. Nobody won this battle. Okay, it started and closed at the same price, up and down. Didn't really go higher or lower in deviation much. Okay, so these are three powerful patterns you need to program into your mind, that whenever you see them in the market in a trend, expect either a major retracement or a major or complete reversal of the prevailing trend. Okay, now let's go into okay, let me see the slides. Let's go into another pattern you would see most times in the market. Okay, now this is what you call your engulfing pattern. Okay, so now the doji pattern, dojis are mostly reversal patterns, meaning you see them form after most times after a trend has formed, and then when they form you see a reversal. Same thing with the engulfing patterns. You have the bullish engulfing pattern and you have the bearish engulfing pattern. For the bullish engulfing pattern, it simply means that price was coming down. You know, you see price coming down, forming the bearish candle, red like this, and then all of a sudden you see a sudden spike or a move, you know, that gives you a bullish candle. Now this bullish candle totally eclipses or engulfs the bearish candle. That is why it is called an engulfing, a bullish engulfing pattern, right? Because it is a bullish candlestick that completely engulfs the previous bearish candlestick. Okay, same thing with the bearish engulfing pattern here. Okay, a bearish engulfing pattern usually happens when the market is in an uptrend, right? And then you see your last bullish candle, okay, and then you have a single bearish candle that completely engulfs the previous bullish candle. That is called a bearish engulfing pattern. So you can see the arrows here indicating that this is indicating that market is most likely to reverse to the upside, while this is also indicating that the market is likely to reverse to the downside. Okay, so let's look for some examples of engulfing patterns in the market. I see one here. You see one here. Can you see this? You have a downtrend, a bearish candle here, and all of a sudden you have bam, a big candle that engulfs the market there. And you can see after that engulfing, the price came down a bit and continued a little higher. Let's look for another example for a sell. Look at this, is a good example. Price going up, right? This is first confirmation for a reversal. You have a pin bar, and then you now have a bullish candle and an engulfing bearish candle that completely engulfs the previous bullish candle. Okay, so this is the basic concept of interpreting chart using candlesticks. So all you are doing is watching the price action and looking for all of these patterns: dojis, gravestone dojis, dragonfly dojis, the other one, what was it called? Like I said, I don't really know their names. The long-legged doji, okay, or simply call this the doji. Okay, you see these patterns, you see engulfing, you see this. It should just let you know this is one confirmation. This is another confirmation that a reversal is a major direction change is about to happen. Okay, so some of these patterns, you will see them in an uptrend. Sometimes you will see them in the middle of trends. Example, let's look for examples. Look at this here. This looks more like a doji. Okay, you can see it form in the middle. Let me see. Example, look at this. You can see this form in the middle here. Most times in the middle of the market here, it's just simply letting you know that, okay, it seems that the buyers are really preventing this market from going down. Okay, and look at this one here. It seems like the sellers are also struggling and preventing the market from going up. So you can see them also in the middle of a trend. Okay, at that point you just use it to interpret, okay, what is going on at that point. But the effect is usually sweeter at the tops and bottoms of price. Example, you see at the bottom here, you can use them to catch big moves. At the bottoms, at the tops like this, at the bottoms like this. Okay, they help you catch very big moves. Okay, you see them at bottoms like this, you see them at tops like this, you also see them in between tops and bottoms like this. Okay, when you see them in the middle, it just gives you an idea of what is going on in the market. But I usually prefer to use such reversal patterns at tops and bottoms. Okay, let me look for another chart and see what we can find. Look at this. Look at this pin bar. After a down move, pin bar, it shows, you can see the market went up. They are usually, remember technical analysis principles, history tends to repeat itself. So the principle here is that most times when you see this in history, when we look back in history, every time we saw a pin bar like this, the market usually reversed. Okay, so we are using the effect from history to try to forecast the future prices. Okay, so this is your bullish engulfing and your bearish engulfing. They are very powerful. Okay, especially when you find them at support and resistance zones. Okay, so in another video I'll be showing you how to combine all of these concepts, okay, into a trading strategy, or how to let you analyze the market and make trading decisions. But for now, I'm just showing you different concepts in technical analysis that you can use to form the basis of your trading and your analysis. Okay, so that is it for engulfing patterns. Okay, so in order of priority, the dojis, the wicks, the type of wicks that show you pin bars are number one for me, followed by the dojis. Okay, now let's look at, okay, so this is basically a engulfing in action. So you see in an uptrend, you see an engulfing, it gives you it's followed by a down move. Okay, now all of these technical analysis patterns, it doesn't mean that they don't fail. They fail. Example, look at this. This is an engulfing. Okay, price tried to go down, it failed, it went up. Okay, and then did another engulfing. So candlestick patterns fail, but we are trying to show you that history tends to repeat itself, and so you can use the fact that every time or most times you see these engulfing patterns, the market usually reverses. Okay, it failed here, but it still reversed. Okay, so the engulfing pattern here was just telling you that, you know what, be careful if you're a buyer. the sellers are coming into the market heavily. Okay, now look at this. You have engulfing here for buy. Okay, and that is how you interpret your chart looking using candlesticks. If you go online, there are materials. Example, you have the Candlesticks Bible, complete ebook, complete training that will take you into hours and hours of, different candlesticks patterns. So it's your duty to go and build on what I'm sharing with you. The trading business, learning how to trade, is not about 100% classroom stuff. It's about you taking the little that you have gotten and then going out there and doing some research and learning on your own. Okay, so most of trading is about learning how to trade is about self-learning. Okay, let's look at some more patterns. Like I said, there are 1001 candlesticks patterns. If we want to go into them, we will spend the whole day and we're not going to be done. Okay, so here are some other prominent candlesticks patterns. You have what you call the hanging man. Okay, they are reversal patterns. So when you find them after an uptrend, it gives you an indication that the market is about to reverse. So when you see a hanging man pattern, a hanging man basically, let me see. Okay, yes. When you see a hanging man pattern like this in an uptrend, it gives you a heads up that the market is trying to reverse and sellers are coming into the picture. This is called a shooting star. And this is exactly what it looks like. I've shown you some examples. Okay. Like I said, you don't need to know the name. All you need to know is the effect. Okay. So when you see this in an uptrend in the market, it should give you a heads up that sellers are coming into the market. Add one or two other confirmations and you can do your sell and make some good profit. Okay. Next, you have what you call the hammer. I showed you an example of this. Okay. It's very, very powerful. All right. Whenever you see a hammer in a downtrend, it gives you a heads up that the market is about or trying to reverse. Most times, it's going to do some reasonable up move. Okay. Then you have the inverted hammer. This is what it looks like in a downtrend. It prints this candle, and so anytime you see this in the market, it gives you a heads up that the market is about to reverse. Okay, so all what I've showed you with the dojis and the engulfing and this patterns here are called reversal patterns. Remember, I did a video on reversal patterns. Okay, these reversal patterns are patterns that happen after a trend or in the midst of a trend, giving you a hint that the market is about to change direction. Okay, there are numerous continuation patterns in candlesticks. So you do that as an assignment. Go into Google and Google candlesticks patterns, candlesticks continuation patterns, and you see a lot of them. And so when you see them in the market, they simply let you know that the price is not about, for example, maybe something like you have something like 3 crores, so the market goes up, you know, like this. Engulfing also can indicate in the middle of a trend. Engulfing can indicate a continuation pattern. Okay, and also in the middle of a trend, your pin bar can also indicate a continuation pattern. Let me look for an example. Example in an uptrend here. Okay, example here, you saw this. It's a good indication that the trend is likely to continue. Okay, so there are so many continuation patterns. So I want you to go on Google, search it, download the Candlesticks Trading Bible, and master as many candlesticks patterns as possible. But as a beginner, okay, I recommend you stick to this major patterns, the most prominent ones, which are the doji, the dojis, okay, the dojis, the engulfing patterns, and this major hanging man, shooting man, hammer, and inverted hammer. You can use all of this, just this alone, to make very, very good money. Combine support and resistance to it, combine your trend analysis, uptrend, downtrend, and all of that, and you could make some good professional trades and handsome profit. Okay, so I hope you learned something new about candlesticks. You know, leave me a comment or your question, or what you think about candlestick pattern. Leave me questions in the comment section. You can share your experiences also about, or what is your favorite candlesticks pattern. If you're a trader already, share that with me in the comment section. Okay. If you learned something new, give us a thumbs up. I want you to also, if this is your first time subscribing to our channel, make sure you click the subscribe button, click the bell to the right of the subscribe button, click all notifications so you can get notified whenever we upload a new video. All right, have a wonderful day. I'll see you in the next video. Cheers.